The direct deposit was smaller than it had been the year before, but the house was the same size. Nothing in the driveway suggested a change. The same SUV, with 3 years left on its loan, sat under a thin layer of pollen. The loan service still arrived on Thursdays. The mortgage drafted on the first of the month, as it had for nearly a decade, tied to a 30-year schedule set during a period when compensation moved in only one direction. For most of his 40s, income had expanded in predictable increments. Annual raises were modest but steady. Performance bonuses arrived each March. Equity grants, vesting every summer, quietly increased total compensation without requiring any visible change in daily work. The household budget absorbed these increases without formal revision. The family traveled more comfortably. The kitchen remodel shifted from idea to contractor deposit. Contributions to a 529 plan accelerated during years when bonuses exceeded expectations. The cost structure of the household gradually adjusted upward, but it never felt sudden. Property taxes rose as home values appreciated across the county. Insurance premiums followed, rebuilding cost estimates that seemed abstract until renewal notices arrived. Utilities edged higher with each rate adjustment from the local provider. None of these shifts required a conversation. They were integrated into autopay. The first reduction in compensation came quietly. The company restructured management layers. A title remained, but the discretionary bonus pool was reduced. The explanation was framed as strategic realignment. No one used the word demotion. Base salary remained intact, but total compensation declined by an amount large enough to register, small enough to rationalize. The household continued as before. Summer camp deposits had already been paid. The private high school tuition schedule was fixed 12 months in advance. The mortgage rate, locked during a low-rate environment years earlier, still felt favorable compared to current market rates. Selling the house would have required surrendering that rate. Staying seemed prudent. The second change was less cosmetic. Equity grants were replaced with a one-time retention payment. Future vesting schedules were paused across the division. The long-term compensation structure that had once created upward drift flattened into a fixed ceiling. Expenses, however, did not flatten. Healthcare premiums increased again during open enrollment. The employer absorbed part of the increase, but the employee portion rose in absolute terms. A deductible reset each January. Predictable, but still impactful during years when unexpected medical visits occurred. The family's out-of-pocket maximum became a number familiar enough to quote without checking the benefits portal. Retirement contributions continued automatically at the same percentage of base salary. The match formula remained unchanged. Yet, because bonuses had once been routed partially into retirement accounts, the absence of those bonuses created a subtle reduction in annual retirement savings. The spreadsheet projecting retirement at 62 had assumed higher annual contributions. No one recalculated immediately. In the neighborhood, little appeared different. Neighbors replaced roofs after hailstorms. Two families installed backyard patios with outdoor kitchens. Real estate listings posted sale prices that exceeded what the homeowner had paid 8 years earlier. The balance sheet still showed appreciation. On paper, net worth had grown. Liquidity told a different story. Cash reserves that once accumulated during high bonus years now stabilized at a fixed level. Annual vacation spending no longer drew from surplus compensation. It drew from savings. The difference was quiet but cumulative. A single trip to the West Coast to visit extended family required airfare purchases that once would have been absorbed by a quarterly stock vest. Now they reduced the checking account in visible increments. The realization did not arrive in a single moment. It surfaced gradually during routine tasks. When reviewing a property tax assessment letter, that reflected another increase. When noticing that homeowners' insurance premiums had risen, not because of a claim, but because regional risk models had shifted. When refinancing options were explored but dismissed because current rates were materially higher than the existing mortgage. The house remained an asset on paper, but its carrying costs had become heavier relative to income. In prior years, annual raises outpaced inflation. Even modest raises compounded over time. A 3% increase layered on top of another 3% increase created room for lifestyle expansion without overt decisions. Dining out once a week became twice a week. A gym membership upgraded to a family plan. Streaming subscriptions accumulated. When compensation slowed, the inertia of those decisions persisted. There was no formal downgrade, no dramatic sale of vehicles, no relocation to a smaller home. The children were entering later high school years, a stage when stability felt especially important. Moving would have disrupted established routines. The mortgage payment, while substantial, was still technically affordable within base salary alone. The margin simply narrowed. At work, performance reviews became more subdued. Growth language shifted from expansion to efficiency. The prospect of significant promotion diminished as organizational layers compressed. The industry itself matured. Startups that once competed aggressively for talent consolidated. Compensation bands standardized. Colleagues began discussing lateral moves rather than upward ones. The long arc of career income had flattened in the late 40s, earlier than originally modeled. The early career phase had been defined by volatility but upward momentum. The middle years delivered peak compensation fueled by bonuses and equity. The plateau arrived quietly, not as a crisis but as a normalization. The household financial structure, however, had been built during peak years. College savings balances were substantial but not complete. Tuition inflation continued at rates that exceeded general inflation. Financial aid calculations factored in prior years' higher income, creating a lag effect in expected family contribution. The household qualified for little need-based assistance. The children's education path had been chosen during years when compensation seemed reliably high. The shift was not catastrophic. Bills were paid on time. Credit scores remained strong. The mortgage amortized steadily. Retirement accounts continued to grow, aided by market performance rather than contribution increases. Yet discretionary space narrowed. A once annual practice of replacing a vehicle every 5 years extended to 7. Home maintenance projects were sequenced more deliberately. A bathroom renovation moved from contractor bids to a deferred folder labeled later. The family still hosted holiday gatherings, but catering was replaced by home cooking. None of these changes appeared dramatic from the outside. Tax liability provided another layer of friction. During high-income years, withholding levels had been calibrated to bonuses and equity vesting schedules. With lower variable compensation, quarterly tax estimates required adjustment. The first year after the bonus reduction resulted in a modest refund. The following year, withholding overshot slightly, tying up cash that might otherwise have provided flexibility. The tax code had not changed dramatically. Income composition had. Employer benefits also evolved. Health savings account contribution limits rose annually, but maximizing them required available cash flow. During peak compensation years, contributions were automated to the limit. With compensation flatter, contribution amounts were reduced slightly to maintain monthly liquidity. The reduction was rational, but it meant less tax advantage growth. The household budget was not rewritten as a formal document. It adjusted informally, line by line. Subscription services were reviewed. Some were cancelled, others retained. Grocery bills rose in response to general price increases. The family noticed but absorbed the change. Friends occasionally reference early retirement as a possibility. Conversations about financial independence surfaced during neighborhood gatherings. The household listened but did not engage deeply. Early retirement had once appeared theoretically achievable if peak compensation continued for another decade. With compensation stabilized, that projection no longer aligned with internal calculations. Retirement at traditional age remained feasible, but the cushion narrowed. Investment statements reflected market volatility. Some years delivered strong returns, reinforcing the perception that asset growth could compensate for slower income growth. Other years erased gains. The household became more aware that market performance, not salary growth, was now the primary engine of net worth expansion. There was a subtle psychological shift in relying on markets rather than career trajectory. The mortgage statement each month displayed principal reduction in small increments. Equity accumulated slowly through amortization and appreciation. The original decision to purchase the home had been grounded in stability, school district quality, and long term residence plans. Those factors remained valid. Yet the carrying cost, once comfortably below a percentage threshold of income, now occupied a larger share. Insurance deductibles were increased slightly to reduce premiums. The change reflected confidence in emergency reserves, but also a preference for lower recurring costs. The trade off was accepted without discussion, beyond a brief review of policy options. Work travel decreased as corporate budgets tightened. Credit card rewards tied to business travel declined accordingly. Points, once used for family trips, accumulated more slowly. The household paid more out of pocket for the same destinations. By the early 50s, the pattern was established. Compensation was stable but not expanding. Cost of living continued its gradual ascent. College tuition payments began in earnest, converting 529 balances into scheduled withdrawals. Cash flow tightened during academic semesters. The family did not feel impoverished. They remained firmly middle income within their metropolitan area. Yet, the earlier years of visible upward movement had been replaced by maintenance. The realization surfaced fully during a routine retirement projection update. A financial planning software tool, accessed annually out of habit, displayed a revised income replacement ratio. Without the assumed future raises embedded in earlier projections, the estimated retirement income appeared adequate but less comfortable. Travel frequency in retirement scenarios was reduced within the model to align with new contribution levels. There was no dramatic reaction, just a quiet recognition that the lifestyle constructed during peak compensation years would not automatically scale forward without active adjustment. The children eventually graduated high school. College expenses continued but were finite. The mortgage balance fell below the halfway mark of its original principal. Retirement account balances, despite reduced contributions, benefited from compounding over decades. Net worth remained positive and growing. The central shift was not insolvency or crisis. It was a transition from expansion to preservation. Maintaining the same house, the same school district, the same insurance coverage, and similar vacation patterns required more deliberate trade offs than before. Opportunities, once accepted without calculation, were now evaluated against annual cash flow. Large purchases were spaced further apart. Appliance replacements were timed carefully rather than preemptively. Career mobility also changed. Switching employers at this stage carried risk. Vesting schedules would reset. Health insurance networks might change, and tenure-based severance protections could be forfeited. Stability became valuable in itself, even if it did not deliver upward compensation movement. The lifestyle built during the 40s proved durable but inflexible. By the late 50s, the household had adjusted to this equilibrium. Mortgage payments continued. Property taxes reflected decades of assessed growth. Insurance costs remained elevated relative to earlier years. Retirement contributions persisted, though without aggressive catch-up beyond statutory limits. Income statements no longer told a story of ascent. They documented steadiness. Looking back, the expansion years had created a sense that lifestyle growth and income growth were permanently linked. The plateau years demonstrated that expenses, once embedded, rarely contract at the same pace income does. They persist, attached to decisions made during periods of confidence. The house remained the same size. The driveway still held a reliable vehicle, replaced less frequently but maintained carefully. The neighborhood aged alongside its residents. Lawns were mowed, roofs were repaired. Property values fluctuated but trended upward over long horizons. The financial realization was not that compensation slows. It was that lifestyle, once constructed at a higher altitude, does not automatically descend with it. The checking account reflected this each month in small, measurable ways. Deposits arrived predictably. Payments departed predictably. The margin between them narrowed but remained positive. The arc of working life had shifted from acceleration to endurance. The numbers supported continuity, not expansion. And the house, unchanged in size, continued to anchor the balance sheet as the direct deposits settled into their new normal.